Morning, everybody. Welcome to the latest in our sessions of updates. Today, I'm absolutely delighted to welcome Paul Mount from the Bank of England in the Yorkshire and Humber agency. I was looking at my notes, Paul, from our last visit, 23rd of June 2020, so almost a year ago. And we talked then about COVID and how we thought it may last another month or two, and perhaps it'll all be gone by the sort of late autumn time. And here we are, almost a year later, and obviously we've now got Delta variants. But on the other side of the coin, we've obviously got a fantastic vaccination program that's been rolling out faster, I think, than anybody could have imagined a year ago. We didn't even have a vaccine then, so. That's tremendous news, and hopefully we can see restrictions lifted in the not too distant future. So 1 year on, where are we? Obviously we've got the G7 summit kicking off tomorrow down in Carbis Bay in Cornwall. We've got a new president in America, and Joe Biden has come to visit us. For the first overseas trip for himself and his wife, so it's great that he's coming to our country to meet Boris today, and with the G7 kicking off tomorrow, as I said. Interest rates are still at an all-time low, but we've got inflation sort of fire burning. The housing market, if you believe what you read, has gone up 10% in the last year. And raw material prices, from anecdotal evidence from clients, are rising at unprecedented levels, and indeed getting those raw materials is also very tricky. So it's a fantastic time to be joined by Paul, and we're very grateful for Paul for taking the time out today to join us. There will be an opportunity to ask questions throughout Paul's presentation. If you just use the chat function at the bottom of the screen there, please ask questions. We have had quite a few questions already, which is excellent. So there'll be an opportunity for questions and answers at the end of Paul's presentation. But before we kick off, I think it would be useful to gain an understanding of the sort of demographic of the people that are joining us today. So just to begin with, there's going to be a short poll, just to see what sort of field, in which sector best describes your business. So you can see up there now what sector best describes your business, be it manufacturing, consumer services, construction, business professional services, or other. So if you could just press the appropriate button, that would be great, and then we'll move on to Paul's presentation. So over to you, Paul. Thanks ever so much, and look forward to hearing what you've got to say.
That's great. Thank you, Chris. Are we going to see the result? Here we go. So we see the results of the poll. So we've got we've got a bit of a bias towards business and professional services, but I guess that's not a huge surprise. But we've got at least one or two manufacturers and construction firms on as well, and someone from consumer services. So we've got a bit of a mix. So that's great. So thanks for that, Robert. If you want to we just close that, that's lovely. So before we go into the slides, I'll just say a bit about who I am and who the bank's Yorkshire and Humber agency is, because I'm conscious that not everyone will know how we're set up. So it won't surprise people. The bank's a fairly London-centric organisation, but I suppose during COVID has become a bit less so, because we've all been working from home, or a lot of us have been working from home, not all of us. But we've had for a long time, I think for a good 20 years plus, we've had agencies in the English regions and in Wales, Scotland and Northern Ireland. And we have really, I suppose, two functions. It's worth remembering that the Bank of England, it's a government-owned organisation, but we do operate independently. So we are part of the sort of public sector, and the remit of the bank is all about monetary and financial stability. So part of our remit is talking to businesses in our region about what they see happening in the economy right now, and we feed that information back into our monetary policy committee that sets interest rates, and also into the Financial Policy Committee that's responsible for financial stability. The other thing we do is we sort of bring the bank out to business leaders in the region. So this is, part of what I'm doing today is we help explain what the bank's up to, and we take questions from people about, what we're doing and why. And again, we feed that information back in. So we're very much externally focused. The Bank of England is actually, as I said, was very London-centric, but we have just announced that we'll be opening at some point next year a new hub in Leeds. So we are looking to, I suppose, modernise and be in the north of England and less southern-centric, which I think is good news. So Robert, if you could move us on a slide, please. So why have I said what's changed since February? So it helps to have a bit of context, is that the bank we do quarterly forecasts. So we do a forecast update every quarter, and we forecast 3 years ahead. And the reason we forecast 3 years ahead is because monetary policy, interest rates or quantitative easing work with a time lag. So the committee who sets interest rates need to have a sense of where the economy is going over the next sort of 2 or 3 years in order to make sensible decisions now about interest rates. So when we last did the forecast in February, interestingly, since then, the UK economy seems to have weathered the winter lockdown rather better than expected. And I'll say a bit more about that in a minute. And that's partly because restrictions have eased a little bit faster than we'd expected in February. So it was after February that the government's roadmap out of COVID was announced. We've also seen things that weren't in the February forecast, like the extension of the furlough scheme, which again I'll talk about in a minute. That's had a huge impact on our prediction of unemployment, brought it down quite substantially. And we've seen a further fiscal stimulus both in the UK and abroad, perhaps notably in the US. So particularly the stimulus announced in the budget has had a big impact short term in how we see GDP developing. A couple of other things that we've seen since February that have changed, I mean, Chris has mentioned this, commodity prices and other input costs, particularly for some commodities and materials are rising, and quite eye-watering increases for some of those. And bond yields, government bond yields and sterling are both a little higher than they were in February. So those are some of the changes. So the forecast I'm going to talk about now was done in early May. So just for context, so it's a few weeks old, but hopefully still reasonably up to date. If you could move us on one, please, Robert. So this chart is looking at the three key economic variables that we track and we forecast. So GDP at the top, the unemployment rate in the middle, and then the consumer price index inflation, which the bank has the 2% target for. So this is really looking at sort of recent performance and also what we're expecting over the next couple of quarters or the next quarter. So looking at the top chart, GDP, I said that the economy had weathered the first lockdown rather better than we'd expected. So previously we were expecting GDP in the first quarter of the year to fall by about 4%. Now the actual figure, we've got 1.6% now, which is prediction. The actual figure that was announced was a 1.5% fall. So the lockdown did affect GDP, but significantly less than we'd expected, and clearly significantly less than during the first lockdown, when those of you with a reasonably good memory will remember that GDP was sort of 25% lower in the April of 2020 than it was on a year ago. So a huge impact back then. So essentially the economy's adapted to COVID. We found new ways of working, and consumers have adapted behaviour in terms of shifting spending online or shifting spending to other things. So it's having less of an impact on the economy. Now in the second quarter, we're expecting a pretty rapid bounce back. You can see there the estimate for GDP in Q2 of the year, which is nearly up now, is 4.3%. And we're expecting that very rapid bounce back in GDP to continue throughout this year. So we think at the end of quarter one, the level of GDP in the UK was about 9% below its pre-COVID level. And with the predictions we have in the May forecast, we think that we'll get back to the pre-COVID level by the end of the year, so by quarter four of this year. Now, that's obviously very dependent on the assumption that we do come out of restrictions broadly in line with what the government was announcing in its path, in its roadmap out of COVID. Now, it may be that things get delayed by a few weeks, which I think won't have a huge impact on the forecast. Clearly, if we do have another wave and people being hospitalized, that would have a big impact. So COVID, in a sense, the COVID and the pandemic, it's still the key risk to the GDP recovery, we would say. So unemployment in the second graph, this is based on the labour force survey measure of unemployment. When we went into COVID, we were at 4% unemployment, which is about 1.2, 1.3 million people. So quite low, a lot of people still, but quite low rate historically. Now we're currently up to, I think, about 4.8% actually was the latest figure. And we're predicting that that will rise slightly from here. And we think maybe peak at about 5.5% in quarter three. Some of you may remember, the Bank of England and other forecasting organisations were thinking that unemployment because of COVID could rise to about 10%. Now it's very much the job retention scheme, the furlough scheme, which has mitigated that and has kept people to a large degree matched to jobs, and has also had a big impact, I think, on mitigating sort of corporate failures. So we're not expecting unemployment to be up at the sort of catastrophic type numbers that we thought just going into the pandemic. And that clearly has a big impact on how the economy can respond and how capacity can sort of increase fairly rapidly during the rest of the year. So it underpins some of that rapid increase in GDP. CPI, consumer price inflation, in the bottom chart. So pre-April this year, CPI was well below our 2% target. So we show the quarter one figure there was 0.6%. Now in April it jumped to 1.5%. That was very much driven by changes in energy prices and also driven to some extent by some of these material and commodity price increases starting to be more reflected in the CPI. Now, I'll say a bit about CPI here, because I think this is one of the areas where we get the most challenge. So it's important to know how the CPI forecast works. So the forecast that the Bank of England does is always predicated on market interest rates. So the interest rate now is 0.1%. The market expectation is that over the 3-year period of the forecast, that interest rates will increase by 50 basis points, so to 0.6%. So some increase, not a huge increase. So in a sense, that is in the forecast. So there is an increase in the interest rate in the forecast based on what the market expectation is. Now, based on that as an assumption, we see inflation rising above target later this year. We think it peaks around 2.5%. And then we see it coming back to about 2%. Now, it may be that there's questions on that, because that doesn't always, I think, mirror well with what people are seeing with materials prices and so on. So I can say more about that in the questions if people are interested in sort of talking more about that. Now let's move us on a slide, please, Robert. I'll start to go through these a bit quicker, and then we can make sure we've got time for questions. So really, this one's just making the point about how resilient the economy has been in quarter one and also in quarter two, and how sort of behaviour has changed quite quickly. So on the left-hand side, we've got transport journeys, and on the right-hand side, we've got visits to restaurants and to recreation venues. And it's really just there to show that actually, as we've gone through the pandemic, the response of consumers and the behavioural changes have sort of speeded up in a sense. So we're expecting throughout the rest of this year that consumption will very much be the driver of the recovery that we're expecting, and that assuming that restrictions are eased as expected and as in the government's roadmap, that some of that consumer spending will start to shift more towards services and away from consumer goods. It's been consumer goods spending to a large degree that's driven driven some of the resilience in the economy so far this year. If you could move us on one more, please, Robert. There's lots of survey evidence we use in doing the forecast, and one of the things that we've noticed is that consumer confidence has bounced back very quickly during 2021. So this is just one particular measure I picked out because I thought it was an interesting one. So this is showing that only 5% of over 80s expect COVID to pose a significant risk after they've received 2 vaccine doses. So looking at a very high risk group who you might expect might be fairly cautious in terms of how they change behaviour after cautious, actually this survey evidence is suggesting that this particular group of people are thinking they will return to some sort of normal behaviour quite quickly. And that's reflected in other survey measures as well. There's a general sense of building consumer confidence and a building sense that COVID is becoming less of a risk to how people behave and what they do. If you could move us on another one, please, Robert. This is a point about the build-up of savings in the economy because of COVID. So because people have been limited to being able to take holidays and so on, and to being able to travel and to be able to spend on certain items, there's been a very big increase in unplanned household saving. We think about probably £200 billion since the start of the pandemic. It's fair to say that that's been concentrated in wealthier households and typically older households who may have a sort of lower propensity to save, to spend some of that money. But there is some survey evidence coming through that suggests that actually people are wanting to spend some of that, and perhaps spend more than we might typically expect based on some of the evidence around sort of unplanned increases in savings. So there's an additional boost potentially to the economy in the second half of this year as people start to run down some of those savings and spend a bit more. What they might be able to spend it on, of course, might be limited. It may be that people aren't able to take foreign holidays this year, but perhaps that means people will be more likely to buy a new car or whatever. Very dependent, I suppose, on the pandemic and how confidence returns. If you move us on one more, please, Robert. Not surprising that COVID's weighed on investment, but this is another survey that the bank runs, which is just showing really that month by month, firms are becoming, I suppose, less pessimistic about the extent to which they think investment is going to, or sorry, the pandemic is going to weigh on their future investment. So this is showing expectations for investment in the next quarter. And month by month, businesses are becoming more optimistic about their investment intentions. And I think part of that for some businesses is driven by the announcement in the budget of the accelerated corporation tax sort of write-offs. If you could move us on one more, please, Robert. Difficult to do a presentation on the economy without mentioning trade and Brexit. And I suppose the key message from this really is that exports, after a big dip in January, have started to bounce back. We think the January dip was broadly because a lot of customers of UK businesses were sort of stockpiling pre-Christmas because they were concerned about the impact of Brexit and the new trading arrangements. So we saw this big drop in January. We also, of course, had the second lockdown and restrictions at ports and so on. But trade has bounced back. In the forecast, we have, a pretty optimistic scenario that actually the hit to GDP because of new trading arrangements is only around 1% in the short term, and that's a temporary thing, that as businesses get used to the new paperwork and the new rules, that things sort of smooth out. On the whole, I think it's fair to say that's what we're seeing, but it doesn't mean that particular businesses aren't very, very impacted. And I suppose it won't surprise people that typically smaller businesses that have got less resource to throw at understanding the new rules and working their way around it, and also businesses, particularly in the food sector, where there seem to be quite significant gaps in the rules still. So there are still some problems with Brexit and new trading arrangements, but overall, we're not thinking it's as significant to hit to GDP in the short term, and the longer term effect, I think, is really, really difficult to know at this stage. If you could move us on one, please, Robert. Just this slide, and I'm sure hopefully Horsons can send around the slides afterwards to people who want them. They're not in any way confidential. This is just showing the furlough scheme on the left hand side. That the number of jobs furloughed has very much mirrored how GDP has changed, and the scheme has been very successful in keeping people in jobs and employed. And we are starting to see on the right hand side quite a rapid pickup in job vacancies, and I'm sure many of you will have been out there recruiting and finding it quite difficult. Certainly businesses we're talking to at the moment are finding it often quite difficult to recruit to particular specialisms, and indeed we've seen things like hospitality businesses finding it to recruit full stop, partly because people haven't yet come back into the labour market, and part we think because there's far fewer EU workers now based in the UK, that a lot of people went home when COVID first struck and haven't returned to the UK. So there's a sense that there's fewer EU migrant workers available for work at the moment. If you could move us on one more, please, Robert. This one's just saying a bit more about inflation and what's driving on inflation. So on the left-hand side, we've got the sort of input and output price indices. We can see very sharp increases in input prices. So, there's been some well-reported huge increases in things like timber, polymers, metals, and so on. And those are starting to feed through into output prices, which again is the left-hand side chart. And that's true for manufacturing, and it's increasingly true for the services sector as well. On the right-hand side, we've got a bit of a disaggregation of what is actually driving inflation. Some of the very low inflation actually in the past 12 months has been due to energy prices being lower than they were in the previous year. So this is the sort of regulated energy prices. That sector has a very big impact on the CPI, and actually because energy, electricity and gas prices have risen quite significantly from April for households, that's very much what's driving inflation in the short term. But as I said before, we are starting to see some of these material prices start to come through into consumer prices. If you could move us on another one, please, Robert. So it talks about a sort of very rapid increase in GDP throughout 2021, but it won't surprise people that as we move into 22 and beyond, in a sense, the potential for the economy to recover returns to something more like normal, and is based very much on how quickly, in some part, how quickly the sort of supply side of the economy can recover and can build up output. So, you slipped back one, Robert, just move us on, that's it. So what happened in the global financial crisis was that because there was a lot of business failure and a lot of unemployment, we saw a huge decrease in the potential output of the economy. We think it fell by about 10%. Now this time, because of the huge sort of fiscal support the government's put in, and it's kept unemployment and corporate failures to a low level, at least so far, that the potential output of the economy hasn't fallen so far. So we're expecting that to return to a fairly normal sort of increase at some point. So generally, we think that the economy can grow by about 2% per annum in a sort of sustainable way without increasing unemployment. So broadly, as we go further out in the forecast, we're expecting the economy to return to that sort of 2% per annum type normal growth in GDP. If we look on the right-hand side chart, it also just, that's it, sorry, Robert, there we go. We also see that for the growth in 2021-22 has seen a big acceleration due to the budget. So there was the COVID-related policy measures like the furlough, there was the investment allowances. Now, over the period of the forecast, that starts to unwind, and we start to see some of the tax increases come through, which puts a bit of a drag on GDP. So not surprisingly, as we go out in the forecast, again, from fiscal policy, we're seeing a bit of sort of drag on GDP. If you could move us on one more, Robert. So the next three charts really are just just our sort of projections out for the 3 years for GDP, unemployment and inflation. So I won't say a lot about these because I've talked through it really already. They're there for information. The basis of the sort of, we call these the fan charts, they show a sort of probability distribution of potential predictions for the variables. So if you sort of drew a line through the thicker shaded region in the middle of the chart in the projection, the right hand side of the chart, that would be our sort of central projection. I suppose the key thing to say here is that there's more uncertainty around the forecast than normal. So those probability distributions are wider, and that just very much reflects that if we've learned one thing in the last 15 months, it's trying to predict how a global pandemic will develop and how restrictions on activity will develop is difficult and fraught with uncertainty. So broadly, the GDP chart showing that very rapid rise in unemployment during 2021, in GDP during 2021, and then a return to sort of more normal growth rates. And if you move us on one, please, Robert. So unemployment there, bit of an uptick to around 5.5% later this year, and then we think a gradual decline back to more normalised levels of around 4% by the end of the period. And finally, Robert, move us on one more. We've got the CPI chart, so a bit above target later in 2021, but then returning to target during the forecast period. And always to be stressed that does build in an increase in the interest rate, because we base the forecast on those market expectations of interest rates. If you move us on one more, please, Robert. I think we've got a couple of poll questions now. So having heard all that, it would be nice to see some views from people about changes in their business. So here's the first one, which is about expectations of your price changes over the next 12 months. To give people a chance to respond to that one. I'm hoping, Robert, that you can see how many people have voted. Yeah, sounds like you are. Are we going to see the results? Yeah, okay, we're going to see the results first. So what have we got? Nobody looking to reduce prices, which I think is probably not surprising given some of the inflationary pressures. Yeah, so increases. So interestingly, quite a few people saying stable prices, about 29%, increased by up to 2%, 37%, and quite a few people looking for quite significant price increases. So 27%, 2 to 5% price increase. And a few of you saying, look to increase prices by more than 5%. So clearly, some of those inflationary pressures starting to come through and how people are thinking about pricing. And then I think we've got another question about your employment expectations, if I remembered rightly. Lovely, thank you, Robert. So how do people expect employment in the business to be in 12 months? I'll give people a minute to respond to that one. Okay, so a really big cluster of people around, I suppose, saying about the same or perhaps a little higher. So I suppose that would be pretty consistent with our sense that unemployment is largely got to where it's peaked. So that's very interesting. So look, thank you for responding to those. I think I've just got one more slide just to say a quick word about monetary policy, and then I'll hand back to Chris to go with some of your questions. So yeah, just on policy. So you'll have seen that bank rate has been held at 0.1%. It's been down at that level for a considerable time. There was a time when people were talking about actually negative interest rates. It feels like, given the strength of recovery we're predicting, that probably that has passed in terms of needing negative rates, although the bank has put in place quite a large programme of work to make sure that the financial system could work with a negative base rate if at any point we ever needed one. But I think the expectation is now that as a response to the COVID crisis, we won't be seeing negative rates. We've got the quantitative easing programme, which is still going on. So this is where the bank buys UK government bonds from financial institutions. I'm thinking we've got about 60 billion of purchases left towards the end of the year to hit that target stock of almost 900 billion pounds of bonds, most of which is government bonds. So a really large bond purchase programme, which seems to have helped sort of keep liquidity up in the financial system and keep loans flowing to businesses. And then the MPC, the Monetary Policy Committee, during COVID has been issuing some sort of guidance, forward guidance, which it does quite regularly, particularly in terms of sort of crisis. So, you know, you can read that forward guidance in that bottom text. Broadly, I think what the Bank of England's Monetary Policy Committee is trying to say is that it recognises there's some inflation risk, but it won't be tightening monetary policy significantly until it can see that there's a really well embedded and sustainable recovery. I think the committee feels that, you know, the risk of raising rates too quickly and putting the economy back is quite significant, and we don't want to end up in some sort of you know, double dip recession. Now, I think that's my last slide, and it's time for Q&A. It is indeed. So I'll hand back to you, Chris.
Thanks, Paul. Thank you for that. So I'll hand over to Pete, actually, because I think Pete's collating the Q&A and the questions coming in at the minute. So over to you, Pete.
Okay, yeah, thanks, Chris. So just as a reminder to everyone, there's the Q&A box at the bottom of your screens. You can submit your questions there. They do come through anonymously, or they can come through anonymously to the panelists. So please don't feel shy. Do put your questions through there, and we'll put them to Paul and gather his views. We have got a good number already through with us, though, Paul. So we'll sort of get cracking on those, and we've got a good period of time now. So hopefully we'll have a nice lively Q&A session. So the first one, just simply because it's come through on the chat box, was from Dave Matheson. I'm happy to be have his name up in lights there. So he's interested in knowing just around this base rate increase forecast. Paul, obviously you talked about 0.6% is where the bank currently views base rate going to over the next 3 years, but sort of when do you expect some of those increases to start filtering through?
Yeah, thanks, Dave. That's a good question. So I suppose the first thing to always say is that it's not that increase is not the bank's expectation of how it will change interest rates. It's a market-based expectation. It's based on sort of future market expectations of interest rates, and we always use those in our forecast, you know, because otherwise there's some sort of circular sort of loop going on, in a sense, if we try and predict where we think interest rates will be. So we always use the market expectation. From memory, I can't remember exactly when that increase is seen as coming through, but I think broadly it's about a year out. So I think broadly the expectation is by sort of 12 to 18 months, interest rates would be at 0.6% compared to 0.1% today. But absolutely stressing that that's the market expectation of where interest rates are going, rather than the Bank of England expectation. But we use that in our forecast.
Okay, so just I guess picking up on that a little bit further then, Paul. I mean, doesn't necessarily need to be a bank view, but any personal views on when you think perhaps an increase in base rate could start to materialise?
I think if you look at our forecast, and if that forecast plays out, that by fourth quarter of this year, you know, we've got GDP back to where it was pre-COVID, and assuming that, you know, the economy is looking healthy, that we're seeing strong consumption, consumer confidence, investment, I would have thought probably by mid 2022 that the Monetary Policy Committee would be looking quite actively at interest rate, changes in the upward direction. It's difficult. It's difficult to know. It does depend where inflation goes. It partly, I think, depends on whether some of these increases in materials costs and so on normalise. I think it's quite hard to predict wage inflation at the moment as well, because the labour market, we don't quite know where the labour market will go. We don't quite know, whether EU migrant workers will want to return to the UK in the next 12 months. But, my best guess is by middle of next year, there could be some pressure for interest rate increases.
Thanks, Paul. I mean, certainly there's some very clear themes coming through in the questions that are being raised. Probably no surprises that sort of inflation, unemployment, etc., are very high on the agenda there. So I guess more of a comment here than a question, but one of the attendees is linked to the construction sector, and their view is that perhaps there's some sort of overhyping of these price increases that are coming through in the cost of materials, but I'm sure lots of other attendees would say that they are seeing very real sort of increases in those prices. But just linking that back into sort of CPI then, Paul, we're certainly hearing from some clients talk about very significant double-digit increases in some of their material input prices. I guess just tell us a little bit about why we're not seeing CPI kind of really rocketing then. What is the difference between those input prices and what we see in CPI right now?
No, it's a good question. My general sense is that some of those material prices sort of hit businesses like manufacturers, particularly. They hit the construction sector particularly. But when you start to look at the price of actual consumer goods, that to some extent, the cost of manufactured goods, for example, might not have such a large impact on final consumer price. It depends on, I suppose, supply chains and the cost mix. The other thing I think to say is, I mean, it varies by businesses clearly, but some businesses do report that they've had some cost savings during COVID. So things like, I suppose a lot of professional services firms like yours will say, well, actually, we've saved a lot of money because staff aren't traveling. So there are some other pressures. I think a lot of firms have looked very closely at the cost structures during COVID, so have managed to find some efficiencies and take some costs out. So it's very difficult, I think, to give an overall picture, but there seem to be a lot of moving parts. Some material prices are really rocketing, and I think, if those sort of levels of increases continue, we'll see some further inflation. But the general sense, I think, is that some of those increases might be permanent, but they'll be one-off. So we may have seen, I don't know, steel prices increase 20% in the last 6 months. Now maybe they will stay where they are, but we won't see them increase, another 20%, I suppose. So if for inflation, we'd need those increases to keep flowing through. It's very hard to know. It's something the policy committee is very, very focused on, because clearly, the general sense is that there is an inflation risk there driven by those sort of prices, but complicated picture, I would say.
Okay, thanks, Paul. And I suppose still sticking with that sort of theme around inflation and supply demand. Question here regarding costs of shipping and container shortages, I suppose also packaging shortages that we're hearing reports of. So how do you see that sort of impacting the overall picture?
Yeah, we hear some horror stories about container prices from sort of $2,000 to $12,000 for, if it's China to UK or whatever it is, and we've been hearing those, I suppose, really for about 8-9 months now, and I think when you speak to contacts, they keep thinking that things are going to normalise, but actually things haven't normalised. Semiconductor shortages are having a big impact in some industries, and lots of other shortages. And I think when we speak to sort of manufacturers, construction businesses, it's often material shortages and supply chain issues which are their main their main challenge. My general sense is, from the businesses I speak to, that we're not going to see a return to normality anytime soon, and that broadly reflects that in a lot of countries across the world, some big producer countries and some big consumption countries like India and Brazil and so on, that COVID is still rife, and that actually, there's been a big disruption to supply chains. The semiconductor sector seems to be a big problem, particularly for the car sector, where there's been a big increase in demand for electronics products, and that's increased demand for semiconductors, and really suppliers just can't keep up. And it feels like actually equilibrium in that market is at least a couple of years away, as capacity needs to ramp up. The capacity can't ramp up very quickly. I mean, I would hope that in shipping that things will normalize a bit more quickly, but it's my general sense is that some of this disruption is going to carry on for at least the next 12 months.
I suppose just on that theme then, Paul, I mean, certainly 12 months ago and since, there was a lot of talk about the various different shapes or letters that the recovery might sort of take. What's the sort of view right now then in terms of the shape of that recovery?
well, the latest one is a K-shaped recovery, and I think this sort of reflects that. I think there's a general consensus now amongst forecasters that actually the economy, GDP is going to recover pretty quickly throughout the rest of the years. We've seen businesses and consumers being very resilient and very adaptable. But there's a growing concern, I think, and the K-shaped recovery is a sort of suggestion that we'll see inequality. So that we'll see actually that some people have benefited from COVID, and typically it's wealthier households who've seen their house prices increase, who've managed to accumulate savings, who've got the sort of jobs where they can work from home, but that actually for less wealthy households, who have houses in areas which haven't seen inflation, or are renting, or are in jobs which are perhaps vulnerable to COVID, so things like hospitality and the travel sector, that actually, there's going to be a job to do to try and support those people to prosper. So there's a growing concern, I think, about inequality, and that's where people talk about that K-shaped recovery of the wealthier getting wealthier and the poor getting poorer, I suppose, is a simple way to put it.
Thanks, Paul. So moving on to some of that sort of employment data that we've talked about so far this morning. Clearly there's a view that perhaps the bank bill unemployment hopefully has sort of reached its peak. But presumably there's quite some divergence in terms of the underlying demographics of that. And I think some of the attendees would be interested to know perhaps what the split looks like. Is there a particular bias in terms of any age groups that are seeing that unemployment affect them more so?
Yeah, there's been quite a lot of evidence come out of that, and it partly, I suppose, reflects this K-shaped recovery aspect, and it's that, perhaps not surprisingly, that it's typically younger workers who've been hit hardest by it, in terms of losing jobs and finding new jobs. So a lot of younger workers in vulnerable sectors like hospitality, travel, leisure, and a lot of people haven't been changing jobs during COVID, so there haven't been as many opportunities and as many vacancies. So I think there will be opportunities for younger workers. I think particularly if we probably assume that there'll be that the flow back of sort of migrant EU workers from the EU, people who were working in the UK but have now gone back to home countries. There'll be a slow flow back, I think, but I think it will be slow. We think, clearly we think there's going to be plenty of demand for jobs, and hopefully some of those sectors like hospitality will be able to bounce back, and corporate failures will be kept to a minimum. But there are more and more firms that I speak to, I think are conscious of the need to take younger workers, train them up, do apprentices well, do them properly. But there are clearly some barriers to that. And I suppose part of the barrier that people often talk to is that it's all very well me as a firm putting a lot of investment into training people up, but because then they get poached, and if people are good, they get poached, particularly if they're in something like IT or technology, they have those type of skills. So I think nationally there is a real challenge to address skills gaps or skills needs in younger workers and make sure that we can train them up. And there's definitely, I would say, a case for public sector intervention. I think there always is in training and development, because it's sometimes difficult for firms to do it, particularly smaller firms without a bit of help.
I mean, just regarding that, you talked a little bit already this morning, Paul, about hospitality in particular and the vacancies that are available there. I think we're certainly hearing some stories that businesses in those sectors are finding it very difficult to fill those vacancies, maybe as a consequence of people being on furlough. Do you see any possibility that furlough could be ended sooner than expected, or maybe some demarcation between sectors regarding the furlough scheme that might help encourage people to take up some of those vacancies?
My best guess would be that they'll leave the furlough scheme largely unchanged, rather than change it again. I mean, that's just a guess. My general sense of the labour market and some of the shortages, talking to firms in hospitality, travel, and so on, is that it's not so much that people are on furlough and aren't coming back, because actually, if they're their workers on furlough, they can push, they can get them back. It's more that some people have found actually that there are alternative jobs out there, and hospitality jobs are tough jobs. If you're on your feet for 50 hours a week as a chef, it's a tough job. And if someone's taken on a job driving for Amazon or working in a supermarket, actually people might have found that that's perhaps an easier way to earn a similar amount of money. So I think it's partly that people have switched jobs during COVID, and some of them will stick in those sectors, and there's some very high demand in some of those sectors. We've seen this sort of shift towards online buying and so on, and we've seen other changes in how the economy works. So I think it's partly a friction in the labour market that it's more of a case that we may need some people to sort of retrain and perhaps think about whether they want to take up a career, say, in hospitality, whereas before that, they've been saying bricks and mortar retail or whatever it is. So I think it's, there's an element of transition there. I think that's what's probably causing the problem.
Okay, thank you, Paul. One of the other sort of themes that's very strongly coming through in terms of the questions being asked is around the housing market. So again, you touched earlier on about the sort of increases in house prices that are being seen. I guess how concerned is the bank about sort of any sort of housing price bubble that we're seeing right now, and I guess again potential inflationary pressures that may bring?
Yeah, I think increasingly concerned. So there's been a couple of policymakers, I think, in the last week or so have been cited in the press as saying, we're keeping a close eye on the housing market, and of course the bank has some responsibilities and some power around regulating that market in terms of, we're able to put rules in place about mortgages and to what extent banks can be exposed to high loan to value mortgages and so on. So a very close eye on that market. I think the last thing we want is a housing market bubble. The general sense at the moment is that a lot of the strength in the market, it is driven by a genuine sort of change in people's preferences. So been well highlighted in the press, much higher demand for properties that have gardens, that are perhaps a bit bigger and have a bit of space for home working. So it's sort of sense that people, are prepared to spend a bit more of their income on housing. But clearly, we're keeping a very close eye on that. The last thing, we want to see is a sort of housing bubble that fuels inflation and makes housing even more unaffordable for those who aren't so fortunate to have huge incomes.
Thanks, Paul. So I think we're starting to get through the questions now that have been posed. So just a final sort of request, if there are any further questions that Anita would like to raise, then probably now is the opportunity. Just one more that we do have though, Paul, is I think there's a story that came out maybe a few weeks ago that back in November, the bank was very close to hitting its QE ceiling. And I suppose it's just a question around what would have been the consequences had that ceiling actually been sort of reached, or sort of worse, needed to go beyond that.
I mean, I think the bank, you know, we set a target stock for quantitative easing. We're not there yet, you know, and we are able to change that target. You know, I think perhaps the issue with QE is, I think that for a long time the bank has been a major buyer of UK government debt. Now, not directly from the Treasury who issue it, but you know, in secondary markets. So at some point, well, by the end of this year, you know, we won't be there as a buyer. So I think we'll be keeping a very close eye on how that market is functioning. But it's not our role to help that market to function. We've been buying government debt because we wanted to pump money into the economy, because the economy has had a huge negative economic shock, and that happens that's coincided with a fiscal expansion as well. So, you know, actually by the end of this year, if the economy recovers as we expect, we won't be in the market for further, you know, buying government debt. So, you know, I think we have a reasonable amount of flexibility as in terms of the operations that, you know, we do in the government bond market. But it's, you know, it's certainly something that we keep an eye on and monitor. And, you know, people are now talking about, well, when would you actually unwind that QE position and start selling back those government bonds? And I think, you know, that's quite a long way off. My general sense is if the bank wanted to tighten monetary policy, it would look to interest rate rises first, rather than trying to unwind its QE position.
Okay, thanks very much, Paul. So I think more of a request in the question was just going back to that point around the sort of demographics of the unemployment data. I know we've not had a slide on that within the pack, but is there some data that you might be able to just sort of add in and we could share around the attendee base along with this?
I'm just trying to think. I don't think I've seen it in a Bank of England publication. I have seen it somewhere, and I'm desperately trying to remember where I've seen it. I think it might have been in an Institute of Fiscal Studies report. So I think for whoever's interested, it's worth having a look at the Institute of Fiscal Studies website, because my memory is that where I'd seen that was from an Institute of Fiscal Studies report, that they'd looked at the demographics. I mean, we've talked about it within the bank, but I don't think we've published any data on it. I'll have a quick look through our last forecast. If I can find it, I'll let you know, Pete, and then you can pass it on. Okay,
that's much appreciated, Paul. Thank you. So I think with that sort of wraps up our Q&A for this morning, which I think is fairly well timed. So I'll just hand back to Chris now for some closing comments.
Lovely, thanks, Pete, and thank you ever so much, Paul, for those very interesting comments. I think, unsurprisingly, the areas that you've sort of focused on have been exactly those same areas that we as accountants have been having discussions with our client base on. You know, CPI and inflation, most definitely high on the agenda of discussion whilst out at clients. And it's good to hear that, you know, the bank is forecasting that rate will come back to sort of around the 2% mark in the relatively short term. Unemployment, again, you know, there is most definitely clients looking to increase their employee base, and so I'm sure that will aid the unemployment numbers to get back to somewhere near where they were at 4%. And interest rates, again, I think, you know, the government's implementation of the super deduction that came in last month, or in April, sorry, has definitely sort of caused many of our clients to look at perhaps strengthening their capital base through capital investment, and the historically low interest rates will help them facilitate that in order to make that sort of relatively cost effective. So you know, those three topics are definitely ones that we're seeing on a sort of day-to-day basis with our client base, and unsurprisingly, those are the topics that you've picked up on today, Paul. So just to close with some thank yous. Thank you to Paul specifically for an excellent morning, and thank you for all the slides, etc. Thanks for Pete for hosting the Q&A, and thanks to all our participants for those interesting questions that we've had today. So I think that wraps it up. Have a good day, everybody. 9:26. So we've stuck to target, and look forward to welcoming you back to another Horson's webinar in the not too distant future. Many thanks now. Bye bye.